Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. Today we are talking about one reason fast-growing companies may want to be C corporations for income tax purposes. Shareholders qualifying for qualified small business stock treatment at the time of the sale can take advantage of Section 1202 to exclude gain from the sale of their stock from federal income tax. That's very exciting stuff. So joining in today's conversation are Barry Weins, Director in our firm's National Tax Department, and Molly Gill, Tax Senior, working in the Transaction Tax Advisory team. So Barry, how's it going today?
It's going well in Tampa. It's a little hot out, though.
How's a little hot in Tampa standards at this time of year?
98 degrees.
Oh, that's hot. Okay.
And we're not into summer yet.
Wow. Okay. Well, yeah, you win. That is hot. All right. And Molly, how are you doing?
Oh, pretty good. It's raining out here. I'm in Tysons, Virginia, so very, very different than the 98 heat blistering outside.
Yep, for sure. And as always, joining me, Sarah McGregor from our Greenville office. Mr. McGregor, how's life treating you?
Life is good, Brooks. It's post-holiday, so we're into summer season now, and always looking forward to an opportunity to talk about tax, because football will be here soon enough.
All right. Well, what's the weather in Greenville like today?
Oh, it's perfect. Low 80s, super dry air. Cold front came through last night. It's just brilliant.
Same for Richmond. They're saying it's going to be the best weekend of the year, so I'm looking forward to it. All right, so let's go to a little background on this QSB topic, Section 1202. We got lots of terms. We'll have to get into some definitions in a minute, but when implemented properly, qualified small businesses can be a powerful tool for attracting investors with funds to fuel the growth of a company. Shareholders can save as much as 23.8% of federal tax on the capital gain realized on the sale of a small to mid-sized business. So we got significant stakes here, and we need to overview about what it takes to qualify for this powerful tax savings benefit. So let's start with you, Barry. Provide a brief description of Section 1202 and maybe explain some of these acronyms that we throw around in this area.
Thanks, Brooks. So QSB stands for Qualified Small Business. And what that means is that looks at the company. Is the company a qualified small business? If the company is a qualified small business, you then move on to it from the shareholder's perspective. And is the stock the shareholder owns in that qualified small business stock? Because there's two sets of requirements here. One is for the business, how the business operates. As you talked about, it must be a C Corp. It must have $50 million of assets under a certain test. When you get the stock, you must have, and 80% of the assets have to be used in a qualifying trade or business. Again, we'll talk about that a little bit later. So that's the business requirements. The business has to meet those requirements in order for it to be a qualified small business. Flipping to the shareholder side, the shareholder must have received the stock directly from the company. So I can't have bought stock from another shareholder. I must have received it directly from the company in exchange for property, money, or services. And then the other requirement is I must have held it for more than 5 years. So those are your two base requirements for 1202. The issue becomes is how are these tests applied, and we'll talk about that. And the key is there's a lot of different sort of traps for the unwary. There's a lot of technical aspects of these tests. And so you've really got to dig down and understand those. That's really where the knowledge of 1202 and how it operates that we've seen and we've done in the number of studies that we can bring to the table.
So Molly, you've done some analysis on 1202 and whether the company qualifies and whether the stock itself held by the shareholder might qualify. So what types of businesses are better suited for Section 1202 than others?
We see a lot of technology businesses. Technology is a very broad industry and can involve a bunch of different sectors, but we see a lot of technology, and from there, really, we just look at there's a few disqualified trades or businesses as outlined in the code. So those would be businesses that rely on the skills of one or more individuals. So think professional services. And then you also cannot have a qualified small business be a hotel, restaurant, or anything related to real estate.
So have you seen where a couple of these 1202 transactions have really helped out shareholders and excluded some gain to their benefit?
Yes, definitely. Yes, we have seen shareholders save in a big way. So we had a situation in which a whole group of founders did not have to pay any tax related to their gain, as it was all excluded under Section 1202.
And we've actually seen 2 transactions that were paused, or the closing date was pushed off by, in one case, 15 days, in the other case, a month, to have another tranche of shareholders qualify because of the significant benefits. So there's a lot of planning on the back end for that as well.
So they needed to meet that 5-year hold.
Correct.
So they pushed it off a bit longer to make that happen.
Correct.
All right, Barry, what 2 or 3 questions or issues do you most often encounter about Section 1202?
So normally when we talk to clients and stuff, that they have generally read up high level on 1202. So they're sometimes asking more for a high level. We talk about the detail. We talk about the 2 sets of requirements. So there seems to be a lot of misunderstanding about the 80% test, how that works. If you think about it, when I say you have to have 80% of your assets used in your qualifying trade or business. So if we're in a technology or software company like Molly mentioned, they say, well, all our assets are used in that trade or business. The answer is, I understand that, but because of the way 1202 works, is there's some tricks and traps with regard to working capital. Working capital, which is your cash, your inventory, your AR, and in a lot of startups, it's really cash and AR, cannot be over 50% of your assets that we use toward this test. So understanding how those tests work, how everything sort of works together. The other issue we find is that people don't understand is sometimes they will have bought back stock. You'll start with 3 or 4 founders, and hey, one of the guys wasn't working out, so we'll bought back some of his stock. We got an early investor, we bought back some of their stock. And in some cases, that buyback of stock can cause problems for 1202. It creates what we like to call blackout periods. So stock issued before or after that date may not qualify. It really becomes problematic when I issue stock. Let's say I issue it on January 1. If I have one of these transactions later in the year, all of a sudden that January 1 stock is no longer qualified small business or eligible to be qualified small business stock. That's a big surprise. So we always try to talk through with clients that type of thing. And one of the other things we try to do is make sure, you start to look at this and examine this early on, because what you don't want to do is, in the normal course of your business, you don't want to create a transaction that will disqualify you from being a qualified small business, or maybe wipe out some of that benefit on stock you've already issued. So having the knowledge of how these rules work can help you as we go along. And one of the examples we have is we had a client, there's a $50 million asset test. They were going to go out and do a $30 million capital raise. That would have put them over the test, which means none of that new money would have qualified. So what we suggested, and what they ultimately did, is we cut that raise into 2 parts. So we did one part on day 1, which qualified. The second part, because it put us over the limit, didn't qualify. So instead of having none of that stock qualified, at least we got part of that in there. So those are the type of planning and ideas that we can help bring to the table to sort of manage through this process.
I think something also that we have to reiterate to clients is that the ultimate benefit of 1202 is at the individual level. So the company does not have to take any position on the actual benefit. And beyond that, two shareholders who have similar facts can actually take different positions on how to treat their gain on their personal return.
So when you're running these analysis for a company or for shareholders, what's the hardest part about collecting information? We're talking a 5-year look back period, I guess, on the stock issuance. What do you find is the most difficult part about collecting information or dealing with clients?
So actually for the analyses, we actually look at the entire duration of the company's existence. So if they started 15 years ago, we need 15 years of data. But beyond that, I think the most difficult information to obtain from the client is just anything to determine the value associated with the 80% test. So the 80% test is based on value. It's not based on the tax or accounting basis. So clients tend to have a difficult time providing us with the information because it's not the information that's on their financials or their balance sheet. And a way that we get around that and try and get the information another way is we ask for 409A valuations, any term sheets, anything that will indicate the actual value of the company at a specific point in time.
So having someone outside or valuing the company for a different reason would provide some input into what the values of those assets were during the time that you're trying to measure.
Yes, exactly.
Follow-up question. Do we frequently have to engage valuation people, go out and do some kind of valuation work in conjunction with this, or is that rare?
So normally, again, as Molly talked about, this is for the shareholders' benefit. So what we'll do is we'll have conversations with management. We'll use the best information we have, and we'll make judgments about where that value is. And sometimes what happens is because if the value is very high, then the 80% we're well past the test. So what we try to do is a sensitivity analysis. At what point do we need the value to be in order to meet that test? And if we can get comfortable with that, then the company always has that option. The downside to going out and getting a valuation analysis is you're generally doing that for a period of time in the past. And so those become very suspect because, you've sort of got you've got hindsight, things along those lines. I think it makes it a little bit harder to do. So we try to look at objective things that were done at that time period to come up with that. So if we were in a real bind, we may resort to that. We haven't had to do that yet.
So Barry, it sounds like this is a great way or to advertise to investors saying, hey, if you invest, we're going to try our best to stay and meet the qualified small business qualification there and be a qualified small business so that you, shareholder, can possibly take advantage of the QB, take advantage of this. I get too many Q's and S's and B's in there.
1202 benefit.
Yeah, the 1202 benefits. So, but what else should an investor be thinking about besides this before they make an equity investment in a company?
So 1202 is an opportunity if you have a C Corp. So remember, the first question you should be asking is, if you're forming a business, is a C Corp the best form of that business? Or should it be a pass-through, such as an S Corp or a partnership? So really, when you go through the analysis that we have seen, is that you've got two issues. One is cash flow from an operational perspective during the time the business is operating. And then second, what's the exit strategy on that business? So if you look at the analysis that we've done on multiple entities, what we find is that C Corps generally, it's like the tortoise and the hare. The C Corps are the hare. They start out much better from a cash flow perspective because their effective rate currently is less than there is on the pass-throughs. What happens though is on the sale, because of the constraints and the tax impact on both the buyer and the seller, is pass-throughs then generally will jump ahead at the end to sort of pass that. The only exception that we have found is when 1202 applies. So 1202 is sort of like having your cake and eating it too. You get the benefits during the operational period, and if it qualifies for 1202, you get the benefits at the back end. But as we talked about, one of the requirements is a 5-year hold. So if I hold my stock 4 years, 364 days and sell, I get no benefit. At 5 years and a day, I get the benefit. It is a cliff. So that's one of the things you have to think about is, what's my exit strategy? You can say, yes, I'm going to hold it for 5 years. If in 4 years somebody comes and offers you a lot of money for your company, do you want to hold it for the extra year to get that benefit, or do I want to take the brass ring right now? So that's one of the things you need to sort of take into account. The other thing that we're seeing now is that when people are investing in C Corps, and they like the C Corps because there's no issues about pass-through income and things along those lines, you just avoid a lot of that, is they are asking up front whether the company is a qualified small business. So they want to know up front, because in making an investment decision, if I have two companies and I have the potential to exclude the gain on one up to $10 million or even more, then, and the other one doesn't offer that, where am I going to invest my money if everything else is being equal? So that's why we encourage companies that are in this situation, after they're going and they think they've got sort of a plan here, to start doing this analysis at least on an annual basis, so that you can tell the investors, yes, we're a qualified small business. We've done the analysis. We intend to continue to operate. We've got our eye on the places where it can trip us up. We've got advisors in place to help us manage through this process and do that. So I think, again, this helps in a planning. In a lot of cases, we come in at the back end right at the time of sale and do the analysis. That's fine if you haven't screwed anything up. But if you have, there's no ability to do that or plan around some of those things. So it's one of those things that if you know about it early, we suggest you look at it, at least be aware of where you can trip things up, whether you do the full analysis or not.
Well, this sounds just too good to be true, Barry. So I made a mistake and I started as a partnership in S Corp. Now I want to go for 1202. Can I do it?
The answer is yes, but you have to be careful about how you do that and when you do that. So with the partnership rules is you can convert to a C Corp under a number of different ways, and that conversion will start. Now that starts your 5-year holding period. So if I was a partnership for 3 years before that, that time period doesn't count. It's my 5-year stock holding period. The problem becomes if the the partnership has too big of a value, and their assets based on that value exceed $50 million, I can't convert, because then I've blown that test. Okay. So you've got to make sure you don't hit that inflection point. If I'm going to do that, I've got to do it when the value is below generally that 50 million, again, depending on what the debt is and things like that. So that becomes very critical. With an S Corp, you can't just go back to a C Corp. We have to go through a couple other steps so that the S Corp becomes the holder of the C Corp stock. Because in order to get the benefit, remember, somebody has to contribute assets into a C Corp. If I just check the box to go from an S to a C, that doesn't qualify. It for the founders. If somebody comes in after I convert, it works for them. Problem is, normally the founders are the ones who want the benefit. So again, if you talk to us ahead of time, there are some very simple steps we can do to make sure you get that benefit. So the simple answer to your question is Yes, you can get there if you're somewhere else, but you have to be careful on how you do that.
And Molly, we're talking about all this, but as you mentioned earlier, the benefit is really to the shareholder themselves when they dispose of their stock and it meets all these qualifications. Now, this is a federal tax provision. What do you think about states? Do states have these same provisions, or does it matter state by state?
So generally, if a state conforms to the Internal Revenue Code, then it would qualify, but we are not offering any opinions here, and we also would not like to say for certain whether or not a state is going to accept it. So we would suggest that you engage with your tax preparer since it is at the individual level.
And to follow that point is, so you could have an individual in a state with income tax, or two different shareholders in states with income taxes, and be treated differently from the state perspective because the state applies those rules differently. So it's really a shareholder by shareholder basis. And again, as Molly had said earlier, we generally work with the companies to help them establish that they're qualified small business. Now, one of the other things to think about here is if you think about the exit transaction. So the exit transaction, let's say, happens today, May 29th. So now the shareholders are claiming the benefit on their 24 return filed sometime in 25. So by the time the IRS gets around to looking at this, it's 27 or 28. So what we try to encourage is to do the analysis. We prepare a report that the company can give to the shareholders. The shareholder now has all of the documentation on why that stock is qualified small business stock, so that if they're questioned 2 or 3 years out, they're not trying to go back because all of those founders are probably no longer at the company and things along those lines. So again, that's something we try to encourage to help make sure you get the benefit and keep the benefit once you're eligible for it.
So document before you go.
Document before you go.
I think you just stated a tax truism regardless of the conversation. But anyway, all right, let's move on to final comments here. So Molly, what you got to say?
I think that Section 1202 is a great benefit for any individuals if you are invested in a qualified small business. And I deal with these all the time. So if you have any questions, always reach out to your tax preparer professional.
And Barry, what you got to say? Well,
saving tax on $10 million of gain, as you said, at 23.8%, that's $2.3 million. That's nothing to sneeze at. And it can go up depending on how much you invested. The rules are tricky. So be careful of what you read out on the internet. There are people who will talk about it in generalities, but not know the nuances. So again, be careful, reach out if you have questions. Happy to have a conversation.
And Sarah?
I think 1202 is one of those very cool provisions in the code that provides a benefit that I think more people, more investors and companies should be taking advantage of.
So from my perspective, I'm struck by this change in the overall benefit entity. I think in the tax profession, there's been a really big knee jerk to go to a pass-through entity for quite some time. And I think, given where we are with the 100% exclusion with 1202, you really have to pause if this corporation could in fact qualify under these provisions. And it seems to align with your exit strategy. So interesting stuff for sure. All right, so that's a wrap on today's discussion about qualified business stock and the opportunity to exclude capital gains from taxation. A quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Bekaert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Molly. Thank you, Barry. Thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.